All right, welcome to the Breneman Blueprint. So for this week's episode, I want to do something a little bit different than usual. So I'm going to put on an episode where I was the guest. So I joined the Adventures in CRE podcast a little while ago. And for those of you who don't know, Adventures in CRE, it's a company that they offer all sorts of resources for people who want to get into commercial real estate. So a lot of their audience is younger listeners, viewers. Adventures in CRE, they offer courses you can take on a bunch of different things real estate related. They have a course on how you can land the job you want. They have a financial modeling accelerator. It's really a great resource. And I'd say probably really out of all the podcasts that I've done, the one I've got the most people reaching out to me after going on as a guest, and I've done a couple dozen of these as guests, and was definitely this one. A lot of young people reaching out that were just getting started in their career that wanted some just advice. So got a great response to it, so wanted to share it with all of you. Talked about my early career, gave advice for people who are early on in their career. I tried my best to go back and share things that I didn't know in my 20s that now I know now, and then also talked about my career path as much as I could and just what I had learned along the way in terms of tips. So here we are. Hope you guys enjoy the episode.
Welcome to the Adventures in CRE audio series. Join Michael Belasco and Spencer Burton as they pull back the curtain on everything commercial real estate and introduce you to some of the top minds in the industry. If you want to take your skills to the next level and be part of a growing community of CRE professionals across the world, this is for you.
Hello and welcome back to the Adventures in CRE podcast. We got a special guest, Drew Breneman, CEO of Breneman Capital. We're excited to have you. And it's interesting. A lot of times when we do these podcasts, we have people in and things are happening in the market that might influence the direction we head with the conversation. But there's one thing that I don't think really relies on a market, and that is the path that you want to take in your career. Do you want to work for an institution? Do you want to go the corporate route? Do you want to start there? Do you want to start your own thing eventually? These are all questions that as we develop our career, we got to figure out for ourselves. And I think a lot of us, myself specifically, want to go the entrepreneur route. Like we want to work for ourselves. We want to explore that. And so I think today we're going to have a really cool conversation about how Drew's been able to do that. And anyway, I'm excited to have this conversation. Spencer, I'll turn it over to you like normal to get us started.
Yeah, sure. Drew, first off, thanks for joining us. So Drew's background is very interesting. I regularly get this question, which is, I'm a senior in college. I'm going to go get my first job. What I really want to do, though, is eventually go out on my own. I want to start my own thing. And the question is, how do you get there? Drew is an example of someone who started the W-2 route, the employee route, and transitioned into owning his own firm now, founder and CEO of Breneman Capital. I know also you're a founder or shareholder in other firms. Maybe Drew, why don't you start by giving the audience a bit of background about yourself, and then we'll dig into what it takes to make that transition from a W-2 into an entrepreneur.
Sounds great. Thanks. Yeah, thanks for having me too. Yeah, really, I sort of always was wired like this, I'll say, in terms of wanting to be an entrepreneur. You know, I had all sorts of different little business things I did as a kid. And then the first one that really worked out to make any real money was I started reselling items in video games back in like 2002. So this is like Diablo 2 and EverQuest, some of these old games now, but I saw my friends playing them. They sold their stuff on eBay for real money. I saw sometimes stuff going for $5, the same item, sometimes for $20, the same thing. So I just started flipping those, and over like a period of 4 years, I made between like $80,000 and $100,000, and I saved all the money.
That is so cool. I love that story.
I tried to invest
off on a really good foot, by the way. I love this.
Yeah, I started investing in what they always say to do: stock market, mutual funds. Same thing that my parents did. They were both teachers, and but I read a book on investing in real estate. It's called Investing in Real Estate by Gary Eldred. It's a basic book. If people listening are already in real estate, they're already way ahead of where that book was at. But I'm reading this as a high schooler, and I really liked just all the aspects of real estate, how he was talking about it. You got cash flow, you're paying your loan down, you have appreciation, tax breaks. So I figured, all right, when I go to college, I'm going to take this money, I'm going to buy my first rental property. And I did. So my freshman year, I bought a duplex for $220,000 in Madison, Wisconsin, where I went to college at UW-Madison, and put $35,000 down on it. And my real estate career was started. Ended up buying 4 properties while I was in school with kind of taking the money that I had made, and also selling one deal to buy the next, or doing the cash out refi. So got 4 deals, but I graduated in 2007. So that's where the W-2 came in, because I'm looking at the market in 2007 going, this is not going to look so good. Thankfully, I invested in student rentals, so my values dropped a lot, but my rents did not drop at all. They kept going up. And so I took a job at a multifamily developer in Minneapolis. And while I was there, one of the interns, he saw all the activity I was already doing just on my own on the side, and was like, we should go meet with my dad, and like maybe he'd want to invest, or we could partner up. I don't like to waste time. So I was like, let's go meet tomorrow. And I printed out a bunch of deals, pitched them on kind of different profiles. I had no idea how much they would invest either. Because again, having parents as teachers, I'm thinking this could be a duplex, or this could be a $5 million deal. I have no idea. So I brought all those sort of deals to them, and they really liked the $3 million 2-tenant shopping center. So we ended up actually not in that meeting buying it or anything, but we looked at the deal. We ended up buying that shopping center that they liked in that initial meeting. So that was our first deal together. And then in terms of the transition, like from W-2 to full-time back into real estate, for the next 3 years, I kept working my W-2 and continued to run the deals I owned in Madison, Wisconsin. And at this point, had relocated to Illinois for a different job, but I essentially was working 3 jobs. So I had a W-2 in Illinois. I had my own properties that I was self-managing, which was really difficult. I remember we were doing an eviction on one deal, and I literally went to court on my lunch break. So it was, this is like a lot of hustling. And then for the deals we were buying with the family that was in the investor, I'm calling brokers on my lunch break. I'm reading the leases at night, on the weekends. But I kept all 3. And I think that's kind of an important thing until from 2008 to 2011. Then I finally quit, but we had already bought 5 deals, with a 6th on the way. So the 3 of us had bought $26 million of property. And then also I had those two of the Madison deals still on my own. So, and you guys will have to just interrupt me. I'll just keep going.
You keep going, Drew. This is great. Yeah. I think this will get to a point. Then I have questions that are building.
No, it sounds great. Yeah, no, I just want to throw that out there because I just can kind of keep going. But yeah, so then, and that was really kind of the start of, Breneman Capital, all of that, where sort of my side of the equation in those partnerships, we kind of branded that as Breneman Capital. But we ended up buying $100 million of property together, the 3 of us, just not where the dad had thrown in, whatever you would have needed 30, 40 million down to buy that. It was, I think he had invested less than 10 million, but it was just, you buy a deal, you raise the rents, you improve the value, you do a cash out refi, you buy another, or you sell it and do a 1031 into a bigger deal. So we built that portfolio up over a period of 10 or so years, and by 2019 it was $100 million. And then same thing, met another family, kind of a similar scenario. This time a father-in-law and a son-in-law saw what I was doing, and we have bought about $100 million as well together. And then around that same time, I started syndicating deals just to high net worth individuals. So that, and now we focus. I kind of glossed over what we were buying, but it was all, for the most part, multifamily in Chicago from 2013 to 2021. And we did really well in those deals. Our average IRR on the ones we sold was a 25% IRR on a 5-year hold. We did 13 in a row full cash out refinances. That's part of the reason the IRRs were high, because we were pulling out all of our money like within a year. Usually we were buying these core plus deals that were newer, nicer ones, but they weren't being run well. The rents were below market. I mean, it sounds easy, like this kind of profile deal, but I spent all year looking at deals to buy like 1 to 3 deals a year. Then we did buy some deals where they were, 100-year-old buildings already renovated within the last 20 years, but then we could just take them up like another level, redoing kitchens, baths, swapping out appliances. And now today I moved to Austin, Texas, and we focus really more on the Sun Belt now, in Phoenix, Dallas, and Austin, multifamily. So that's been kind of the whole run so far. So yeah, it's been it's probably, I was surprised I bought $2 million of property when I was a college student, and it's kind of nuts how it's gone so far.
So let's come back. I think an important piece that was missed in the story is, at what point did you go full time as an entrepreneur? Right, you give up the safety blanket of the W-2. What was that moment, and describe what was the catalyst? What allowed you to do that?
Well, really, it was putting in the work, ahead of quitting. So call it if I bought my first deal in 2005, and then got my first job at the start of 2008, and then I quit in 2011, my W-2. So, it was really working at, 1, 2, or 3 sort of different jobs, if you want to call them that, or things on the side for quite a while. And that's been a common theme where people that I know that have quit their jobs as well. I have on my podcast, I had a couple of my Chicago, we'll call them buddies, that had launched their own firms as well. And it was the same story. One of them said he built his whole business while all his friends were watching college football. Another guy, did the same thing I did, except he kept working all of it until he was in his 40s. And now he has like $1 billion multifamily portfolio. But he had a huge portfolio just on the side as being a debt broker. So yeah, I think that's kind of an important part, I thought, was sort of doing all of it at the same time to get it built up. Because I think it's really difficult if let's say I would have not started anything so far in 2011 and then just decided I'm going to quit and go out on my own, but I have no deals, I have no track record, I have no partners yet. It would all just have been conversations, and so that I think is a hard, because yeah, what you asked, it's a common question I get asked too, where it's, how do I go out on my own? And really, like, to me, the answer is you need to start doing it now. So the reason that family in Minnesota invested with me, it wasn't because I just had the best pitch ever or something. I had already bought 4 deals, and it was just, you can get on board with what I'm already doing. So it was already, they saw the activity and, a lot of proof of concept, I guess, at that point, where it wasn't just like a theory. So
was there a metric that you were looking for that you said, when I hit this number, maybe it's distributions back to you, maybe it's a certain size of a portfolio, but when I hit this number, I'm going to quit? Did you have that number in mind?
The way I was thinking about it was, maybe once you thought your job was costing you money was the time to go. Mm-hmm. Where at that point, what I was making on each deal, I needed like a couple of those deals to replace my job, my wages. So I had exceeded that, by the 5th deal, and I still was working. Also, I did see value in what I was learning at the job too. So I wasn't just like in a rush to get out of there. And so, because I had worked at a multifamily developer for just a year, but they did tax credit development. So I learned a lot in that year. And then I worked at a retail developer. And so I learned, everything. I didn't know really anything about commercial property when I started. And I learned a lot there. So I wasn't in a rush to get out, but really more my metric was sort of, I feel like this job is costing me money now, meaning whatever I'm getting paid, I think I could make more than that, just reallocating that time to the next deal.
Spencer, can I jump in real quick?
Please.
I want to go back because you said something that we kind of glossed over, but I think it is so important, especially right now. I mean, in 2023, when we're going into some economic fun times. I think that there's one thing that you kind of glossed over that people really need to hone in on. And that was the fact that your first investment vehicle, the vehicle that you chose, happened to be student housing, right?
Yeah.
Right. And a lot of times, so back in 2007, running up to 2007, if you were a mortgage broker, I happen to be in the mortgage business, own a mortgage company. And if you could fog a mirror, you could make money in mortgages or real estate. And a lot of that was happening in real estate in the last 2 years. If you were a real estate agent, if you can fog a mirror, you can make money doing this business. But who is it? Warren Buffett that says, when the tide goes out, you see who's wearing the shorts, right?
Yeah. Who's naked. Right?
That's right. Yeah. You see who's naked. That's right. And so I like the narrowing down on the concept of product market fit. Okay. And so when you were looking at student housing, did you think, oh, I want to buy student housing because there's some security in that type of cash flow vehicle? Was there some thought into this is the product that I need to do while I'm in school? Any insight into the product market fit that you chose?
Well, the honest answer would be no. I think that, because again, I was 19. So a lot of the stuff, folks listening that are working in commercial real estate, that you guys know and work with, like they know way more than I did at that point. And that sounds like a great strategy at the time and for right now, where if the market's choppy and student rentals are going to hold up, which that's been proven as being a good product sector for, when it's recessionary. But there really wasn't. My strategy was actually even more simple than that. It was, I wanted to buy something that was cash flow positive, where at a fair price, which sounds so simple, but that's also what allowed me to do the deals. Where if I would have thought I'm going to be a developer, I'm going to get a deal built, I'm going to do this and this, or I'm going to focus on value add rehabs, there's so many moving pieces. Who knows if I would have ever gotten started. Yeah. But instead, I found a deal. I figured out how people were valuing these with the gross rent multiplier. I saw one that looked on the low end in terms of GRM. And then I really spent a lot of time making sure I understood what the rents should be and the expenses. Because again, I'm brand new. I have no real estate experience. So I spent a lot of time focusing on the cash flow, because I thought my worst case scenario is again, it's my own money. So I'm not thinking what's my IRR or what are my returns. I didn't even know what an IRR was at that point. I just figured if it's cash flow positive, my worst case scenario is I just hold it. Yeah. I'm cash flow positive, and then I overpaid, so I need to just hold it. I can't sell it and make money, but I'm going to just own this thing for 10, 20 years, and I'll make money on the other side and learn a lot. And so, honestly, that'll be my advice today, where you could own or occupy a 1 to 4 unit and get that one of those FHA loans for 3.5% down. My parents, they didn't lend me any money, but if you have family that can lend you money, it's fine. You can even get your down payment lent to you in that program. I had the down payment from the internet business, but I don't even know if you need that now, if you could get a loan or partner up with a family member. Someone I know did a deal where she and her, I think sister-in-law just went 50-50 on a deal with that same loan program, and her sister-in-law was the one who qualified for the loan, and she put the money in. So they, I guess to being creative, early on, you don't have a lot of resources, so you got to be creative and resourceful.
Yeah.
So.
Well, there's a few components here, Sam, that to me, Drew as a 19-year-old made total sense. The first is, it's what he knew. He just rented a place at college. He knew that people pay to have a roof over their head. And if the amount of cash flow that he as a 19-year-old exceeded the outflow that he had in terms of operating expense and mortgage payments, it was a good investment, right? And then he described some of the downside, going, okay, I can hold this long term or whatever else. But at the end of the day, it was something he knew.
Yeah.
Even as a 19-year-old kid, he understood. The other piece is it was in front of him. He's at I'm
UW Madison
here, Drew, but
yeah.
Right, you're at UW Madison. You weren't going to buy a shopping mall in LA. You're at UW Madison. You understand student housing is right in front of you, and so there's too many people that when I talk to them say, I want to become an entrepreneur, but I don't know what property type to do, or I don't have enough money. It's like there are opportunities right in front of you. Yeah, it may not be the perfect time or the perfect property type, but sometimes it's better just to get started, to take the little bit of risk. And that's what Drew as a 19-year-old did. And then 1 became 2 and 2 became 4. And what he's doing now is much larger scale. But he didn't say as a 19-year-old, well, I can't buy a 300-unit apartment complex, or I can't buy a newly built Amazon leased industrial building, so I'm not going to do it. Right?
Yeah, I had no idea how those worked. So I would have. Yeah. I think you're right. And I think even people who maybe they would think they live in a bad market, and so let's just, beat up on Chicago because I invested there a long time, but you're in Chicago, you think it's a tough market or something, but you live there, you know it, you can run it better, you understand the rents. So there's the same thing in Madison. I bought it. I knew that I could get more for the rents than the current owner was getting. I had, to your point, a huge group of friends. I could poll, what are you guys all paying, and do my market study or whatever you want to call it, just in the dorm room. And so you're right. I think that too. And then owner occupying it allowed me to put less down and get a lower rate. So that was also helpful too. It's to the numbers, obviously.
And when Drew talks about owner occupy, what he's saying is you can buy a duplex, live in one side and rent out the other side. Yeah. And in a perfect world, the rent from the other side pays for your rent and nothing else you save on rent. You go to a fourplex and you can go up to 4 units and still get conventional financing, which is what he's referring to, kind of an FHA government loan, where you have to pay a minimal amount down and because you're owner occupied. Anyway, the point is, and this isn't an exercise in what's the right investment, there are investments staring everyone in their face. And instead of going, oh, one day when, or if only I would do it, why not now? So I think that's a great point. Let's talk about education, if we could, in the last 5 or 10 minutes. I hear a lot of young entrepreneurs who say, I'm wasting my time at college, or I loved how you described the value of your W-2, the value of the companies you're working at was you were getting great education. Or put another way, which might be a little rough, is you were learning on someone else's dime.
I think that's right.
How do you view, or what do you say to people who say how college is a waste of money, working for someone's a waste of money, just get right into it? What do you say to someone who has that view?
I kind of thought the same thing when I was in school, like when I was in college. So like, I totally get what you're asking. And because it's easy if you're 19 where you go, wow, I got to spend 4 years and I got to go to school. This is going to take like forever, which is funny now to think about. I'm almost 40. Like, yeah, you went to college and you got out when you were 22 or whatever. Like, wasn't that long when you look back. And same thing working at these places. It wasn't like I was falling behind or anything, which I think is kind of the feeling people get. But yeah, I think college is important, just in terms of for obviously the education you get, but also just kind of the, how people perceive you, is still like, most people would be expecting, that you'd have a college degree at any of these sort of, white collar jobs. So I think it's needed. And then I know you want to maybe go out and be an entrepreneur right away, but then you don't, the typical, like, what are you going to fall back on? Like, I think that's legit, but also it's like, there's not that much, in the grand scheme of things, it's not that much time, how much you're spending on it. And so, I still see a lot of value in it. I think one thing, and I don't want to derail the whole conversation, I do think some of these private schools that are so expensive and aren't at like the top tier ones, I think that's sort of a, almost like an education bubble of sorts. So I don't see the value in that. If you're going to the whatever 11th best private school in Wisconsin or something, I didn't think that was a good use of money, but I'm going to the best public school paying in-state tuition. Like, that made a lot of sense for me. So that would be my thought on school. And then, yeah, for the job, one thing I would really recommend to people that are starting out in their career. I know it's easy to say now where, I'm older and have made money investing, so it's easy to give out this advice, but you should really think about what you're going to learn at the job more than what you're going to get paid, which, because what you don't realize, let's say if you're starting out and you're comparing a $65,000 a year job with a $75,000 a year job, well, when you're 40, the 10 grand you made after taxes when you were 23, that money has disappeared. Who knows where it went? It probably went to a vacation or, just being wasted on the weekends anyways. So like I think you should focus on what you're learning, because imagine if one place you're you're not getting to the right spot. That's another thing I try to talk about is you want to think about where do you want to get to, and then just get to that spot and don't worry about the company so much or the pay. Just, am I getting the right experience to do what I want to do? So if you want to go out on your own and invest in real estate, don't take a job at like some sort of rating agency, being like, an analyst, like try to get on the deal side, even if it's like feels like a lower job or you get paid less, or, be a broker, try to be in the mix on deals. If that's what you want to be out on your own someday, even if the pay is way worse or the title's lower. So,
as you talk, it reminds me of the classic Navy SEAL phrase, slow is smooth, smooth is fast. And when you're 19, you don't understand the concept, because to your point, 4 years is an eternity to a 19-year-old. And no offense to our young listeners at all, but one of the best pieces of advice I got is from my grandfather. And I was thinking about, do I go back to business school? And at this point in time, I think I was 29, which is old, by the way, for a prospective business school student. And he and I were talking, and he finished his law degree when he was 35. He served in World War II. He had a family and a variety of things. And he said, Spencer, that extra year or two is not going to make any difference in terms of the acceleration of your career. But what you're going to learn, the people you're going to meet, is going to be far more valuable. And so, Drew, when you describe being 40 and looking back and saying, oh yeah, if I start when I'm 21 versus 23, it really makes no difference. The people you meet makes a world of difference. And to me, by the way, and again, not to derail the conversation, the greatest value in college are the people that you meet, and the credibility that you gain from having demonstrated that you went through something tough. Totally agree. There's an ROI to every school, and there's certain schools that are not a high ROI
right.
relative to others. We're almost out of time. This is a pretty important topic. First off, if someone listening wants to reach out to you, what's the best way to get in touch with you?
I think if just in terms of you want to learn more about stuff like this, I have my own podcast, the Breneman Blueprint. It's a real estate investing podcast where we get into talking about doing your first deal, or like I had those guys I mentioned that started their own firms on to hear what they did, and did a hour plus with them, kind of hearing their whole story and the moves they made. So that you can get on YouTube or any podcast platform. And then I'm also on social media at Drew Breneman everywhere. I actually just signed up for TikTok even. So I'm on them all. I'm on them all now.
Love it.
Yeah. My sister works in social media for a jewelry company, and she's like, you got to get on TikTok. Everybody's there. But anyways,
so we'll be sure to share. We'll be sure to share that in the description of this. Last question, and unless Sam, you want a follow-up to finish this up, but last question. So if let's imagine you're 19-year-old Drew again, and you're living in Austin, Texas now. What is 19-year-old Drew going to UT Austin? Let's imagine instead of UW Madison. What do you invest in?
I mean, it would have been the same thing, except I'd be doing this call from my yacht with how Austin's gone.
That's right.
But I mean, I would have just done the same thing. I'd be like, I'm a student. We got all these properties here. I'd do the same thing. So I don't think there would have been anything different. I didn't realize how easy it was to get a loan initially. So I mean, I had a down payment and I owner occupied. I could have pushed and probably bought more deals. But I mean, I was also a student and figuring it out. So it wasn't, one a year would still seem like a lot. So yeah, would have done the same thing. I just would have, and that's part of the reason I moved here and we shifted our strategy to the Sun Belt is I would have had a giant tailwind behind me where, the Minnesota and Chicago multifamily markets were mostly where we were buying. It hasn't been a big help. It's been pretty flat. We've created a lot of value on our own, but if we would have done those deals in Phoenix, then the market would have, tripled them as well for us. So would have been nice.
Well, Drew, you're an inspiration, and it's fun to hear your story. I'm sure that quite a few people listening can relate. Either they're at the 40-year-old age of the story, or they're young and they're thinking about this. And so, thank you for coming and sharing your insights. Yeah. Sam, I'll let you give the last word and wrap us up.
Yeah, this has been a fun podcast. Entrepreneurism is a near and dear to my heart, and I think everything. There's so many lessons that, as Drew, you were sharing just the different things you went through and, starting the business, growing it, that I just thought, oh man, yeah, just, work hard, always learn. Going to school is important, but once you're done with school, you can't ever stop learning, getting experience. That's important. Sacrificing what you want most for what you want now. Like right now, I don't want to work 3 jobs. Well, you got to sacrifice, because the thing I want most is out in the future. And so that's what it takes. That's what it takes to be an entrepreneur. And so this has been a lot of fun for me to just even go down some of my own memory lane and just replay those same experiences myself. So thanks for coming. And for the listener, thanks for listening. And we'll see you on the next episode.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.